Hello and welcome to this Tuesday's morning market briefing. We've got lots to talk about, but firstly, risky hedge fund bets risk the whole collapse of the US bond markets after they over leverage shorts and long positions on US Treasuries. As well as that, there's been a global kind of decline in the share values as a result of rising oil prices, as Russia and Saudi Arabia continue their oil supply cuts. And finally, the ban on gold in China is lifted finally, and as we see that as the yuan recovers. But as well as that, we've got lots to talk about on the charts. There's lots of opportunities on the Nasdaq, especially, as well as opportunities with the dollar, and in relation to that Euro USD, pound yen, and Bitcoin. But we'll all come to that near the end. But let's get straight into it. As well as that, we've also got lots of economic data coming out today, including lots of inflation data and some other building permits data to do with the US government. But let's get straight into it. So the first article to talk about really is hedge funds betting on US Treasuries. Now we know hedge funds obviously make large risky bets, but recently we've seen large issues surround the US Treasuries market as over leveraged positions become clear, with positions, as we'll speak about, on bonds. Now, the Bank for International Settlements issued a warning in its quarterly report released on Monday about the growth of a so-called basis trade. Now, this is where hedge funds seek to exploit the tiny differences between the prices of treasury bonds and their equivalents in the futures market. So obviously we have the cash market where you can just buy bonds outright, and then we also have the futures market where those bond prices are predicted in another market, basically. So we have these two comparable markets, but both in relation to US bonds. Now, one thing was mentioned, that being that margin deleveraging, if disorderly, has the potential to dislocate core fixed income markets, and that was from the Financial Times. And this is in relation to any sort of market where there's positions which are highly leveraged, and this is where you're taking out debt to basically purchase a position, and with a larger amount. So for example, I may have worded that incorrectly or poorly, so I'll try and explain this a bit better. It's as if you're going and you think that oranges are going to go up in price from £1 to £1.30. Instead of just going out with your £100 and buying 100 oranges, instead what you would do is take out a loan where of $900, and you would use 100 of your own dollars and 900 of the bank's dollars to buy these oranges, and as a result you have a much larger position with much larger potential returns. However, what comes with that is much larger risk, and so when you start to close down these positions, the large inflation of the asset prices, which has been created by your investment, your large investment, then suddenly collapses, and quite fast, especially if there's a margin call, but we'll come to that. Now, the US Treasury market is one of the most closely watched markets in the world, and it sets borrowing costs for the US government debt, with $700 billion changing hands every day in August. Now, in August, the Fed said there had been a rise in the volume of basis trades placed, and warned of possible financial stability risks, which risk due to hedge fund bets in the bond markets, which could pose a threat, and these have been building up and building up. Now, in the futures market, traders typically use margin to magnify the value of their positions and supply only a fraction of the value of the total trade, and this comes with what I explained earlier. And the BIS warned if the market moved against highly leveraged futures against the highly leveraged futures investors, they may be forced to ditch their positions, triggering further market sell-offs. And this is what we call a margin call. This is where you're basically taking out so much debt on a position which you believe is going to go your way. But what ends up coming is it doesn't go your way. As a result, you're kind of left without the capital to cover the debt, and as a result, the position closes all of a sudden, and the bank takes the collateral, or whatever issued you the loan. And as a result, when that happens, these assets fall in price massively, whether it be they're over leveraging long positions, or in the inverse for short positions. And this is creating unstable markets and unsustainable markets, really, that can't continue for long without an issue possibly arising. And obviously, as we understand, one market's fall could cause another markets to fall. And so with just the US Treasuries becoming unstable and possibly seeing a crash as a result of these risky hedge fund bets, this could cause a crash in foreign exchange markets, let's say. Because if there's too much collateral in relation to the hedge funds, they don't have enough collateral to cover their forex positions. As a result, there's a decline in certain currency. So, within a hedge fund, they're not necessarily always just trading one asset, and so you have to look out for this systemic risk which can evolve just from one failed trade in one market. So keep your eyes on that. It is a bit worrying, but we'll come to that again some other time. But the next article to talk about really is the global shares which have been declining as a result of rising oil prices, and as a result of shareholders waiting for the bank meetings that are taking place this week. Now, European and Asian equities fell off while US benchmarks were muted on Monday as investors sold off semiconductor stocks over fears that consumer demand is beginning to slow. And we've been speaking about semiconductors a lot recently. It is a main kind of topic of discussion in relation to markets and as well investment. And it's been very key in terms of South Asia, but also now with the UK's own listing of their own semiconductor company. Now, European and Asian markets posted declines, with the region-wide stocks Europe 600 going down 1.1%, and that's one of the leading European indexes, while the Hong Kong Hang Seng Index gave up 1.4%, and South Korea's Kospi fell 1%. Now, the Wall Street's benchmark S&P 500 gained 0.1%, and the tech-focused Nasdaq composite advanced 0.2% in New York. Now, we'll come to those assets near the end where we can do some chart analysis, but if you're still at this point in the video, please like and subscribe. It really does help me so much. But yes, last week Taiwan's TSMC, the world's biggest contract chip maker, told its main suppliers to delay delivery of high-end chip making equipment, and this kind of caused a ripple effect within the US stock market. Well, not so much in the US stock market, but a lot of people that were invested in TSMC kind of lost a lot of their faith within their market, because obviously a lot of the markets within and around China's economic influence sphere, we've seen a lot of instability around that area. And so it's no surprise that investors are becoming worried around certain stocks in relation to that area. Now, TSMC also lost 3.2%, and has been warning that the recent boom in artificial intelligence technology is struggling to compensate for broader economic headwinds and China's stalled recovery. And this is what I was just speaking about. Generally, when there's that regional decline, it affects all the countries around it. And so with China's issues within their own economy, this is also affecting other economies around it, such as Taiwan, and this is being reflected in TSMC's share price, as well as the issues along with artificial intelligence technology. Now, the heavyweight US chip maker Nvidia also declined 2.3%, while the UK chip designer ARM lost 4.7%. after last week completing the largest initial public offering on Wall Street in nearly 2 years. Now, we haven't spoken about this IPO that much. However, it's been pivotal in the UK stock market, with it being, I think, the biggest, as I said, on Wall Street in 2 years. Now, this move came as traders prepare for interest rate decisions from the three world's largest central banks this week. And we've spoken about this in yesterday's video. We spoke about the upcoming meetings that were going to take place, and those meetings being in the US, the Federal Reserve is expected to keep the target range unexchanged at between 5.25% and 5.5%. As well as the Bank of England, which is due to hold an interest rate setting meeting this week, and that's forecast to increase its benchmark bank rate by 1/4 percentage point to 5.5%. And whilst the Bank of Japan is expected to keep rates unchanged at -0.1%. So lots of central bank meetings taking place this week, as well as inflation data that we'll come to at the end of the video, so stay around till then. And now, the next article to really speak about is China lifting its temporary curb on gold imports, and that's coming as the yuan recovers. Now, China's central bank has lifted temporary curbs on gold imports that were imposed on some lenders in a bid to defend the yuan, but as a result caused the price of the precious metal to increase in the currency, and that it increased by a great amount. And to most, this would kind of be an obvious result of something like that. If you're increasing the scarcity of an asset like gold, you're bound to see an increase in the price. However, this wasn't really the focus of China. It was more so in an effort to deal with the declining yuan, which had been struggling as a result of recent economic data which came out in relation to that. And obviously, whenever there's an issue with a domestic currency, generally investors put money into gold as it's a safe haven asset, and it generally does the opposite of leading global currencies. And so as a result, China was trying to prevent people from doing that and taking their money out of the yuan and putting it in gold by just banning gold outright. Now, banning gold's imports, now, the spread between Shanghai's gold price and London hit a record $121 per troy ounce last Thursday. The spread narrowed to $76 on Monday after the People's Bank of China relaxed curbs on imports and the price of the precious metal last week. Now, China in August had reduced and stopped granting quotas for international gold imports by banks to ease a rush in purchases to hedge against a weaker domestic currency. And this is what I was speaking about. They were trying to prevent all these leading investors for hedging their bets with gold, which many do often, instead of and as a result taking their money out of the one that was already declining. And obviously China didn't want it to decline any further. Now, the yuan fell to its lowest point against the dollar in 16 years in early September after the release of disappointing economic data, and this is really what triggered China's response of banning gold, basically. Now, China's central bank also issued a strong warning against bets on the yuan depreciation last week, and has rolled out measures to defend the currency, including state bank purchases and lowering foreign reserve requirements at banks, because obviously we understand that a lot of these banks hold gold as a safe asset to hold in case of defaults within the bank or issues around liquidity. However, they're reducing that ratio that banks actually need to hold, and as a result reducing the demand for gold, hopefully, and reducing the demand for foreign currencies, and so more is going into the yuan. Now, The currency has bounced back from a low to trade around the 7.286 mark against the dollar on Monday afternoon, and Chinese regulators calculated that the yuan may have been weaker if the gold import ban was not in place, because a potential buying frenzy in dollars would cause further capital outflows and the currency to come under pressure. So it's clear that, China was trying to protect their own domestic currency by reducing, the purchases of foreign assets. Now, China is among the top global buyers of gold and has been raising its reserves, with the People's Bank of China saying in August that it bought gold at record highs for the 10th month in a row. And gold demand in China is expected to increase ahead of the traditional wedding season in October. So although, China's been trying to reduce the amount of gold being purchased, it's actually likely that in the coming months it's going to increase greatly. Now, but this is in contrast, however, to global gold watchers, which have remained cautious about the long-term outlook over sort of softening investment in jewelry, as well as the softening jewelry demand, and central banks also globally potentially pulling out of their higher levels of purchases. But that's all for the articles. Let's move on to the charts, where we have lots to talk about, with firstly the Nasdaq 100 presenting the most opportunities. Now, we've been speaking about US indices quite a lot recently, and for good reason. We've got the Fed's interest rate decision coming up this week, which always has a great impact on the US indices market. And not too long ago, we obviously had NFP data, which triggered interesting response from the markets. Recently, I also spoke about the potential on a buy for US indices, and generally in the lead up to these big interest rate decisions, we generally see within that country's markets this kind of range to be formed within the market of support and resistance, with prices moving in between those as kind of these funds, these hedge funds and firms attempt to hedge their bets within the market and get buys and shorts within the market, so that they're ready for an interest rate to move either way. And as we can see here, this is an area that I've highlighted a while back in relation to there being a great deal of liquidity, along with the 50% Fibonacci point on the Fibonacci retracement tool. And this is an area which, in my opinion, would be an ideal position for a buy. As for areas of resistance which might be formed in the coming days as we run up towards the FOMC interest rate decision, these are the sort of areas that I'd probably be looking at. Areas of high liquidity, strong resistance, because as we can see, this is areas that's been used for liquidity before, areas that's been used as resistance in the past, and areas that have been used as resistance quite recently. But yeah, definitely this would seem like an ideal area for buys, and we've kind of seen that already take place as prices punched into that liquidity zone and past that 50% Fibonacci area. But we're seeing similar patterns on other US indices, such as the Dow Jones, which has kind of dipped after recent data and after recent news in relation to share buybacks. And with the US 500, we've got a similar picture as the Dow Jones. So keep your eye on the US indices as we run up to US interest rate decisions. But the next to talk about really is the dollar, which we've spoken about a lot. Obviously, it's always so important to talk about. It affects all other markets. And the most important thing to talk about here is its retracement opportunities. Now, I spoke about recently the position that it was in. It kind of seemed overvalued after it had broken out from this prior high, and so it was probably likely to retest. And now price has come down and retested this area of previous highs, where there's likely to be lots of orders, lots of liquidity, and lots of upside potential as a result. And we'd already wicked into there prior. However, we've returned to that level, and we're currently sitting in that area now going into Tuesday's session. It's also sitting on the 38.2% Fibonacci area, and so as a result, it seems like an ideal buy position within the dollar. But once again, the dollar is very unpredictable in the way it moves. It's not the same, sort of situation of it being paired against another currency. This is just the dollar against a basket of other currencies, so it's quite hard to, make trades on. But generally, if we're looking at where the dollar might go based on just technical analysis and, not looking at fundamentals, it would seem like it's an ideal opportunity, in an ideal spot to possibly continue to move higher, but we'll see what happens with that. But the next to talk about really is Euro USD, which in my opinion, in contrast, in a confluence with my dollar perspective, the Euro USD is in an interesting short position. Now, for a long time, we've been talking about, since at least we broke through this trend line to the downside now, I spoke about this area of strong liquidity, which was a prior low, and we've come down now and made this double bottom. Now, before breaking double bottoms, if fundamentals generally are saying, we're going short here, we're going down, it doesn't just necessarily mean that we're going to break through that strong area of liquidity. Buy orders will be there, hedging positions will be there. As a result, we're likely to see some sort of retracement like we've seen. However, if we understand the fundamental picture is generally short, and that's what we've heard from the ECB, despite recent differences in rhetoric from more hawkish members of the ECB, in relation to the larger picture around the ECB reducing rates earlier than all other banks, it would seem that this is an ideal opportunity to gain a short, especially around the 50% area on the Fibonacci retracement tool, just simply because there's a high level of liquidity, it seems, where it's been generated and accumulated before, as well as, it being on the Fibonacci chart. But that's all for Euro USD. It does seem like there's good short side opportunity on that. But coming back to GBP JPY, not too long ago, I kind of drew out this area at the very bottom of this large channel, which GBP JPY has been ranging around in and moving higher in. And we're really now reaching the lows of this channel and reaching the very bottom and extension of the Fibonacci retracement tool that we've drawn out from here down to here, and it's nearly reached the bottom of this channel. So it'd be really interesting to see whether we actually still make a bounce off this trend line to the high, making new highs, which I would say, we've probably got quite, a great likelihood of that, just simply due to the fact that we've got, the Bank of England's interest rates decision coming up very soon. And as a result, it's likely that we're going to range. It's not likely that we're going to be falling in the value of the exchange rate. It's likely that it's going to stay around the same. And so to me, we might come down and tap it and move a bit higher, but we'll be staying around this area until the Bank of England makes its decision. So it's an interesting position for GBP JPY. But the last to talk about really is Bitcoin, which is in a really interesting position because it's broken above this range that we've been talking about for a while. Now, we've spoken about this range where Bitcoin's price has been accumulating, but also having fake breakouts from. As we can see here, a large upside move in line with SEC court rulings and decisions. And, we thought the SEC was going to give way to, new Bitcoin trusts for certain firms. However, it turned out that to not be the case. So price once again returned into this range. And then when we got different news around Bitcoin, we broke lower, but now we've broken back into it. And, we've been ranging around this area for a while, but finally we've broken above, and it does seem like we've retested, or at least we're about to retest this area. So it'll be interesting to see whether it does retest and move higher still, or just returns back to this area of accumulation. But if we were looking to upside potential, I do think that this 38.2% area is the most ideal for an upside opportunity, and that's simply because it is existing within this prior area of resistance where prices wicked up into many times before, and so it's likely to be a high level area of high liquidity as a result, creating lots of opportunities to the upside. But that's all for the charts, really. Oil is still staying around its areas, and gold is continuing to make highs. So the next thing to talk about really is the economic calendar, and we've got lots happening today. But first off, we've got the Aussie central bank, the RBA's meeting minutes being published, as well as Eurozone core inflation rate being published, along with its normal, basic inflation rate, including, the oil and the fuel prices. But remember that including the fuel prices and food prices, but remember, core inflation rate is really the one that we're looking at to try and decide, how the ECB might make its decisions in relation to the euro. So keep your eye on, the ECB's results in relation to core inflation as well as normal inflation. Along with that, we've also got Canadian inflation data coming out, as well as US permits figures coming out, building permits figures coming out, and finally the Bank of Canada's one of the Bank of Canada's officials doing a speech. So lots of data and decisions being made today. So keep your ears open for that, and keep your eyes on your charts, as well as looking at the economic calendar to see the proper results of this data. But that's all from me today. Have a great Tuesday trading day. Hope you're well. And yeah, please subscribe and like if you've made it this far. It really does help. And yeah, see you later. Bye.